Nebius just touched 150. About a year ago, it was trading near 20, which means the stock has delivered roughly 650% returns in just 1 year. That is a massive move for any company, especially one that only got listed on NASDAQ in October 2024. So the big question is, what exactly is driving this surge? Part of the excitement is coming from growth headlines. Nebius is reportedly in talks to acquire Israeli AI startup AI21 Labs, a company focused on natural language processing models. That could help Nebius expand beyond pure infrastructure and add more depth to its AI ecosystem. At the same time, the company is also expanding aggressively on the infrastructure side, including a new AI factory in Finland with planned capacity of 310 megawatts. On top of that, analysts from firms like Cantor Fitzgerald, Citigroup, Bank of America, Compass Point, and others have been turning more bullish on the company. And despite all of that bullishness, Nebius still seems to be moving even faster than many analysts expected. The market cap has now climbed to around 36 billion, and the stock is being seen as highly volatile, with a beta of around 4.2. In this video, we will talk about why NeoCloud companies like Nebius and CoreWeave are getting so much investor attention, what the major contracts and energy commitments of Nebius look like, what key risks investors should keep in mind, and finally, what analysts are saying about the stock's target price. To understand Nebius, we first need to understand why the market is getting excited about AI cloud in the first place. Broad cloud and AI cloud are related, but they are not exactly the same. Broad cloud includes general-purpose computing, storage, databases, networking, and platform services. AI cloud, on the other hand, is a more specialized GPU-heavy layer of cloud infrastructure built specifically for AI training and inference. That is why investors are starting to separate the two in their minds. Traditional cloud is still dominated by hyperscalers like AWS, Microsoft Azure, and Google Cloud. But companies like Nebius and CoreWeave are attracting attention because they are much more focused, more specialized, and more directly exposed to AI infrastructure demand. They are being seen as pure-play AI cloud providers. The market opportunity is also one of the biggest reasons for the hype. Synergy estimates that the NeoCloud market is just over 25 billion in 2025, but could reach nearly 400 billion by 2031. That is why investors are paying such close attention to this space. Right now, CoreWeave is the bigger player on the basis of current revenue. It generated around 5.1 billion in revenue in financial year 2025, giving it roughly 20% market share. Nebius, by comparison, is still much smaller today with revenue of around 530 million, representing only about 2% of the NeoCloud market. But what investors are really focused on is where Nebius could be going. With agreements involving Meta and other major companies, Nebius has projected that revenue next year could jump to around 7 to 9 billion. And looking further ahead, some projections suggest it could even reach as high as 35 billion by 2031, which would imply market share of nearly 9% and make it one of the top 2 companies in this market. Now let's talk about the contracts, because this is where much of the excitement is coming from. Nebius and Meta already had a 3 billion deal in place, but now that relationship has expanded even further with a new 27 billion agreement for AI infrastructure over 5 years. That new agreement is structured in 2 parts. The first part involves 12 billion of compute, where Nebius is expected to provide Meta with Vera Rubin systems in 2027. The second part gives Meta the option to purchase additional compute capacity of up to 15 billion. One well-followed analyst has pointed out that Nebius's backlog now includes a Microsoft contract worth up to 19.4 billion and Meta capacity agreements worth nearly 30 billion. There is also a belief among analysts that Nebius may sign at least one more major hyperscaler deal over the next 12 months. And then there is Nvidia. Nvidia recently committed 2 billion for an 8.3% stake in Nebius, which adds another layer of credibility to the company's position in the AI ecosystem. Altogether, that brings Nebius to roughly 49 billion in contracted backlog, which is extraordinary for a company doing around 530 million in trailing revenue. There's also an interesting feature in the Meta agreement. The contract reportedly includes a backstop structure, meaning Meta has the right to purchase any remaining Nebius cluster capacity that is not sold to other customers. That is a very important detail because it means Nebius is reducing the risk of idle capacity. It gives the company much better visibility, supports utilization, and may even improve pricing confidence. At the same time, it gives Nebius room to keep building and then gradually diversify its customer base over time. Why these agreements matter, and why investors should still stay realistic, Fred. Now, these agreements are clearly impressive, but we should also stay realistic about what they mean. Nebius may become one of the important players in the NeoCloud market, but that does not necessarily mean it will become the dominant player. This is already a competitive market with several serious participants, so while Nebius may deserve a premium because of its growth story, it may not always trade like a business with a deeply protected monopoly-like moat. And that is important because Nebius is not the only NeoCloud company attracting major customers. CoreWeave already had Microsoft as its biggest customer, accounting for 67% of its 2025 revenue. Meta has also expanded its relationship with CoreWeave through another $21 billion cloud deal on top of an earlier $14.2 billion agreement. CoreWeave is also tightly connected to Nvidia infrastructure. Lambda has announced a multi-billion-dollar multi-year agreement with Microsoft to deploy tens of thousands of Nvidia GPUs. Crusoe is building a 900-megawatt Microsoft AI campus in Abilene, and that broader ecosystem has also been linked to OpenAI and Oracle workloads. Crusoe has also expanded its Nvidia relationship, and Nscale signed an expanded Microsoft deal tied to roughly 200,000 Nvidia GB300 GPUs, and later announced a West Virginia project involving both Microsoft and Nvidia. So yes, Nebius is getting a lot of attention, and for good reason. But it is important to remember that it is operating in a space where multiple companies are racing to secure contracts, power, capacity, and customer relationships. Energy capacity. Of course, contracts only matter if the company can actually deliver the infrastructure behind them. And that brings us to the energy side of the story. Nebius has recently outlined plans to deploy more than 5 gigawatts of capacity by the end of 2030. That is a huge number, and it shows how ambitious the company is trying to be. One of the biggest projects is in Independence, Missouri, where Nebius has received approval to develop a gigawatt-scale AI facility with potential capacity of up to 1.2 gigawatts across roughly 400 acres. Power delivery is expected to begin in late 2026, and development is expected to continue through 2029. Then there's the new Finland project. According to Inves, Nebius is planning a 10 billion 310 megawatt data center there to expand AI capacity. The site is expected to come online in phases beginning in 2027, and the company has said this facility will support both AI model training and application deployment, while not being dedicated to a single customer. That point matters. It suggests the company is trying not only to fulfill large contracts, but also to build a broader platform that can serve multiple customers over time. Major risks. If you're excited about this stock's upward move, then do remember that a stock with a beta of 4.2 can also fall very fast, and any of the following risks could become the reason. Execution risk. The bigger question is whether the company can actually execute at the pace the market is now expecting. Nebius is trying to scale extremely fast, and that creates several layers of execution risk. There is build-out risk, which means delays in data center construction, power connections, or equipment installation. There is financing risk, because this kind of growth requires enormous capital spending and may put pressure on shareholders if more debt or more dilution becomes necessary. There is customer concentration risk, because a few major clients are driving a large part of the story. There is also supply chain and hardware risk, especially when it comes to obtaining enough advanced GPUs and related infrastructure on time. And finally, there is competitive risk, because Nebius is not alone. It is competing against both specialist NeoCloud providers and major hyperscalers to capture a larger share of this market. So overall, the opportunity is large, but execution will matter much more than just the excitement of the story. Customer durability risk. Another important risk is that these big tech deals may not represent a permanent moat. Right now, AI demand is very strong, and major technology companies are also turning to specialists like Nebius to supplement their own internal capacity. But over time, some of those same customers may continue building more of their AI infrastructure in-house, especially for strategic or sensitive workloads. That matters because investors do not price a stock only on current contracts. They price it based on future growth expectations. So even if Nebius remains under contract with large customers for the next few years, the stock could still face pressure later if investors begin to believe that the biggest customers will increasingly build their own infrastructure and rely less on outside providers. The positive side is that Nebius management appears to understand this risk. Arkady Voloshin has framed the Meta and Microsoft contracts not as the final destination, but as fuel to accelerate the build-out of Nebius's broader multi-tenant AI cloud platform. In other words, the company seems to be using these giant contracts to scale faster today with the goal of serving a wider customer base tomorrow. Another major issue for shareholders is dilution. Nebius raised about $4.2 billion through convertible notes, which gave the company access to financing at relatively low interest rates, ranging from 1% to 2.75%. That sounds attractive from a financing perspective, but the trade-off is that these notes may eventually turn into shares. Now, that does not necessarily mean full dilution, because Nebius has the option to settle conversions in cash, shares, or a mix of both, but the overhang is still there. Based on the company's own filings, the worst-case stock settlement scenario could lead to roughly 50 million new Class A shares being issued. If that happens, total shares outstanding would rise from around 253 million to roughly 303 million. That means an existing shareholder's ownership stake could fall by around 16.5%. So while this financing gives Nebius more firepower to grow, it also creates a meaningful dilution risk, and that helps explain why the stock came under pressure when these loans were announced. Now let's talk about price targets. And just a quick reminder, this video is not financial advice. Even after such a massive run, analysts still remain fairly constructive on the stock. D.A. Davidson analyst Alexander Platt reiterated a buy rating and raised the price target to 200 from 150. At investing.com, 15 out of 18 analysts have given the stock a buy rating, with some analysts keeping the price target at 200. Citizens JMP analyst Gregory Miller has a price target of 175. Citigroup is also bullish, with a target price of 169. At Public, 91% of analysts rate the stock a buy, and 55% of them suggest strong buy, with a price target of 161. At Stock Analysis, the consensus also leans strong buy, with a price target of 163 and a high target of 211. And Market Screener has a target price of 162, with a high target stretching all the way to 291. Before moving forward, I would appreciate it if you would subscribe to the channel to stay updated with the stock market. It would also help a small channel like this grow. So yes, the stock has already moved a lot. But the interesting part is that the analyst community still does not seem to think the story is over. In fact, if Nebius continues executing well, expanding capacity, and converting backlog into real revenue, then the bullish case could still have further room. The way the stock has been moving, it almost feels like 200 is no longer some distant number. It is starting to look much closer than many people once thought. Now let's briefly look at ownership, because the cap table also tells an important story. Nebius still looks very much founder-controlled. The biggest owner by far is Lastar Trust, the trust tied to founder and CEO Arkady Volozh. It holds 30.79 million Class B shares, representing around 55% of voting power and about 13% beneficial ownership. The reason the voting power is so high is because Class B shares carry 10 votes each. Vladimir Ivanov held 6.85 million Class A shares plus 3.32 million Class B shares, equal to 4.27% beneficial ownership. Among other major holders, BlackRock holds 3.73%, Fred Alger holds 3.14%, Excel holds 2.70%, and UBS Asset Management holds 2.39%. Several hedge funds and large investors have also taken fresh positions in Nebius, including Parkside Financial, Root Financial, SHP Wealth Management, Blue Trust, and Armstrong Advisory Group. Institutional investors own around 21.90% of the company's stock. There's also been some insider selling, but from the look of it, that appears to be mostly tax-related, rather than a broad sign that insiders are dumping shares aggressively. The more notable ownership change is actually Orbis, which has significantly reduced its position from around 6.6%. So to sum it all up, Nebius has become one of the most closely watched names in the AI infrastructure space. The company is benefiting from a powerful mix of factors: explosive stock momentum, major agreements with Meta, Microsoft, and Nvidia, rapidly expanding energy commitments, and a market that is becoming increasingly excited about pure-play AI cloud companies. At the same time, investors should remember that this is still a very aggressive growth story. Execution has to go right. Revenue and commitments need to be converted into profits and cash flows. Customer relationships have to remain strong, and dilution may remain a real risk. If you got value from this video, do like the video. Thank you for watching, and I will see you in the next one.